So we are back for the second part of our conversation. And just to pick up from where we had left, we were talking about the Russell 2000 and, its underperformance relative to the S&P 500 and whether there was still value in small cap stocks. And maybe if Axel or Michael would like to add anything, I would be more than glad to let you proceed. Is there anything that you'd like to add before we move on to the next question?
Well, the only thing to add is, right, I mean, obviously, the question is always, what is your investment goal? And when we talk about what's going to perform well, we always compare ourselves to the S&P 500. Well, most people, I'm sure, Roy, ask your neighbors, right? Is their goal in life to beat the S&P 500? They have everybody has different goals, right? And so that is really the important thing that we shouldn't lose sight on. And so when you listen to a discussion like this, keep in mind what your goal as an investor is, because that will have implications. Just as Michael points out, right? If you think you're going to miss out going back into the market and you're okay that the market goes down sharply, well, be my guest, right? It's everybody has different priorities, and so and it depends on the sort of situation one is in. In 2007, I sold all my stocks that I had because I foresaw the sort of crisis that we might be getting. I didn't know all the details that would play out, right? This time around, I still have some stocks. I said, okay, well, if they do poorly, so be it, right? With the core of my portfolio, I do. And I have in special sectors, I have more stocks, but it really depends on one's preferences together with one's assessment of where things are going to be.
One more thing, I have to. Axel made a good point, or at least it prompted my mind to think there's such a thing called a risk-adjusted return. So if I underperform the S&P by a few percentage points in various years, but risk-adjusted return is much higher. In other words, I never lose the 30 or 50% drawdowns that you have in your account on a regular basis, given the artificial construct of our Federal Reserve and our fiscal policies. Then my return, on paper isn't quite as good. But depending on when you start investing with me, you really enjoy the fact that you never have to suffer those huge drawdowns.
And both of you mentioned the S&P 500. I'm just curious. We know that the S&P 500 has experienced significant growth in recent years, with some analysts predicting that it's suggesting that it's overvalued. Do you share this assessment? And what sectors or industries do you believe are most at risk of a potential market correction? I know just a few minutes ago I received an email newsletter from Axel, the Merk Investments fund, and you're talking about some electric vehicles and things like that, and we know that will have some positive impact on the S&P 500. Would you please elaborate on that? Is the S&P 500 overvalued?
Well, let me give an answer that I'll maybe give Michael a chance to disagree on some of what I say. I believe that we are currently in an environment, right, where interest rates are rising, that might be stifling economic growth and be disinflationary. That said, I do think on a broader picture that the Federal Reserve, when they stopped hiking rates 75 basis points, 0.75%, went to 50 and then 25, that was a secular pivot in the environment that we're in, that we're switching back to a reflationary world. Now, that doesn't mean that tomorrow all the boats are going to rise again. But in that sort of environment, international markets will outperform as we have China trying to, quote unquote, reflate the economy and so forth. Now, obviously, this is not going to happen in a straight line. I'm absolutely on board that we're going to have a severe recession. But a big reason why the dollar hasn't done better in the current environment is because that secular force is pushing against that. And in the context of your question, the S&P has done so well for so many years that a lot of money has piled into that. And I think a lot of these investors are going to be very surprised how well international markets will perform relative to the S&P 500. Doesn't mean they can't all go down, But just imagine that the sort of pessimism we had in Europe. Now, there are plenty of problems in Europe and so forth, but of course that's reflected in the value, and similarly in many emerging markets, right? So by all means, this doesn't mean it's going to be a straight line, doesn't mean these markets will outperform, but absent of a panic where everything surges to the dollar temporarily, I do think that in the years to come, there will be more opportunities in equities outside of the S&P 500 than the S&P 500.
Michael?
Well, I'd love to disagree with you, Axel, but I don't disagree with you at all. I think we're going to quibble about duration. I do see a recession in the United States, and half of the world's yield curves are now inverted. It's not just the United States 210 spread. Half of the world's yield curves are now inverted. So we're going to have a recession. It's going to be global, and during recessions, the dollar tends to strengthen. And if the recession is acute in nature, and I think given the leading economic indicators, and I can rattle off about 50 other things to tell you that this is going to be a very severe recession, and chief among them would be the real estate market, the dynamics there. You could have a credit market crisis, and when the credit market freezes up, everybody wants short-term treasuries in dollars, which is not going to be good for foreign stocks. But then, that's the part where Axel and I might debate over. But then after that, I think you're going to have a protracted decline in the value of the dollar after Powell comes in and lowers interest rates again towards 0%. After he comes in with another QE program, after Janet Yellen, that Chinese wall that's supposed to exist between the Fed and the Treasury, well, that doesn't really work. If you could say Chinese wall anymore, I don't even know. But there's supposed to be a wall between those two entities, and there isn't one. So I call it an unholy union between the Fed and the Treasury, just like we had helicopter money in 2020. We're going to have the same thing again, where we monetize directly, just go around the banking system and send people checks. The dollar is going to go down precipitously, and it's going to be great for foreign stocks. But then to your question about overvalued, the overvalued nature of the stock market, I think is a prima facie event. It's just without debate. If you look at the two most important metrics to measure the value of the S&P 500, which is, in my opinion, total market cap of equities to GDP, and includes the S&P 500, and the price to sales ratio, those two metrics are higher than at any other time in history prior to 2020. So from the signing of the Buttonwood Agreement all the way to 2020, you will never find a higher price to sales ratio or a higher total market cap to GDP ratio. And that unbelievable overvaluation exists in the context of the fastest rate of change in rate hikes in history, while we're doing quantitative tightening, and while we have negative GAAP earnings growth. If that's not that is the red flag of all red flags of going blindly into a buy and hold strategy into stocks, to quote a famous pusher on CNBC. Buy stocks.
Let me just comment on one nuance. I agree that there might be a credit event. The context, though, is that the Federal Reserve is petrified about a credit event, right? They are all happy going higher for longer as long as credit markets are holding up. And I believe that the moment we will see, and last year, of course, we had several of these potential candidates. Remember the gilt disaster in the UK, for example, or when swap lines started to be extended to Switzerland, but they didn't materialize into major credit events. If and when we have a major credit event, I think on the blink of an eye, the Federal Reserve is going to pivot. And because of that, the strength of the dollar that Michael is suggesting is far more muted than it otherwise would be, because the market is just waiting for that to happen. And it's part of the reason why the market expects the rate cuts to come in the future, right? They're just getting ready. Okay, is it going to be today? Is it going to be today? Is it going to be today where they're going to do it? And since markets are forward-looking, that helps to reduce the rise of the dollar. Now, obviously, how that's exactly going to play out in practice, we don't know. The only point here is that don't underestimate the Fed's ability to go back down to zero when something hits the fan.
Yeah. So, and I know
I just want I agree 100% with you. I think the only argument would be well, do you want to hold stocks into that and wait for that pivot to happen? I think it's going to be when a credit event happens, they happen, it happens in response to stress in the banking system. That's the duration of time I don't want to be long that particular asset class. And since
you can't forecast that necessarily, right? You don't know when that will happen. There's nobody there saying, hey, tomorrow a credit event is going to happen, right? So you want to be positioned before, and I 100% agree.
Oh, okay. Michael, I know we have less than 3 minutes. Maybe I could just, I have a question for the two of you, but maybe I was thinking you would go first, maybe in a minute or two before you move on to your other engagement. I don't know whether that would be okay.
Yeah, sure. Go ahead.
Yeah.
Absolutely. So I have to around 10:45. So we have another 4.
Yes, for 5 minutes. So both of you have written books that, as I said in the beginning of our conversation, revolve around the concept of the debt, the global system being highly leveraged. So I wanted to ask the question, the US Treasury has remained low in recent years, despite concerns about inflation. And we currently have been talking about that and rising debt. What do you see as the primary drivers of the current low yield environment? What would you expect the yield to be in the second quarter of this year?
So you're asking me what the average yield on the debt would be? I'm sorry, I didn't understand the question. I didn't hear.
Yeah, so let me repeat the question. The US Treasury yield has remained low in recent years, despite concerns about inflation and rising debt. What do you see as the primary drivers of the current low yield environment, and what do you expect the yield to be for the second quarter of 2020?
The current low yield environment?
Yes.
Compared to what? I mean, right now we have 2-year treasuries at over 5%, and if you compare that to the dividend yield on the S&P 500, it's like 1.6%. The earnings yield on stocks are 5%. So I don't know how low these yields really are. They could go much higher in intractable inflation, which I see on the other end of this cyclical disinflationary environment. So excuse me. So what I see on the other end of this deflationary environment. But the main problem we have is debt and deficits. Oh, I'm sorry, I apologize. I lowered the ringer on this phone and it keeps. Let me just make sure this ringer is indeed off. I apologize. So we have the CBO came out with estimates that we're going to have $20 trillion in new debt added over the next 10 years. That's assuming, by the way, there's no recessions, and the average interest on that debt is 4%. I will tell you that I'll take the over on the average interest, and I will bet you in the next 10 years we have a recession. So we're going to have much greater debt, and of course, when you have much greater debt to service, that requires higher interest rates. And even if the Fed monetizes that debt as they've done in the past, you're talking about higher inflation. So we're in a much higher inflationary regime going out over the next decade. So interest rates are going to be much higher than 4%.
Okay. So I just wanted to make sure that we did it into your time. It's right now 10:44 Eastern time, 10:44 Eastern time. So we have less than 30 seconds. So in this few seconds, I would love to appreciate and thank you for making time for this engagement while I proceed with Axel. So thank you so much. And
thank you, and Axel. My pleasure to be on with you.
Yes.
Great to see you again.
Yeah. So I hope we shall be doing more of this. I'll be sure to invite you as frequent as your schedules would allow. So
take care.
Yes, thank you so much. So Axel, the same question to you. The US Treasury has remained low in recent years, despite the inflation and rising debt. How would you respond to that?
Well, the only thing I'd like to add to what Michael said is there are, of course, some unique constellations in the US, as some of your viewers may be aware. There's the debt ceiling debate, and so there's going to be an environment where they have to do a lot of juggling to get through how the law works in the US on the debt issues. But yes, it is a challenge, and the big issue here is that there are implications, right? We talk about the S&P 500, the Russell, where the bond market is, but there are really much broader implications for society as a whole, because when you spend more money on servicing your debt, there is less money for other things, notably national defense, for example, and other things. And it is Paul Volcker, the former president of the Federal Reserve,
yes.
he talked about three verities. In order to have a stable government, you need stable prices, you need sustainable deficits, and you need sound institutions. And then he explains how we have neglected all three of those. And so we will, there is going to be a tomorrow, right? But it's a tomorrow that's less prosperous, less stable. And it's not just your investment portfolio. When things are unstable, people are unhappy. They elect more populist leaders, right? I mean, you're hosting this from Africa. Several countries do not have sound institutions, and it makes it more difficult to invest. It makes it more difficult to create wealth. So these very simple things, right, and make a difference. And so if you go back to the US, sure, the US will pay a little bit more on the interest. It's going to affect the yield curve or the bond prices, but there are real implications that go way beyond just whether you have an allocation to stocks or bonds. And that is something that I think isn't said enough, and so that's why I want to share it here.
Yeah. So okay, we've been talking about the inflation in the US right now as it is. There's been significant debate about the appropriate level of inflation, whether we should aim higher. Previously, a few years ago, there was the 2% inflation targeting that was established. Do you think that it would be appropriate to maybe, shift the goals, maybe to 3%, 4%? And what is your view on this and the impact that you believe this will have on the economy and on the financial markets?
Well, I'll give you two different answers. The first one is no, you must not change that, because once you change it once, when is the next time you're going to change it, right? The credibility of that target is eroding. Now, of course, you can work on the margin, and what the Federal Reserve did in switching to a backward-looking 2% target, we can talk about it. That's, I think the technical term is idiotic, because that doesn't work that way. But in any case, you got to hover around that 2% target. You cannot go higher. Now, the other answer I give you, I just mentioned Paul Volcker. Paul Volcker was the Fed chair who beat very high inflation that came from the 70s and early 80s, put interest rates to very high levels. But even when Paul Volcker beat inflation didn't go down immediately to 2%. It took several years after him that Greenspan was able to get it there. And so the current Federal Reserve, they will have to talk about a 2% target. They will work towards a 2% target, but they're not going to lose any sleep. If inflation comes down, it will hover more in the 3% range for a while, right? And so, but it's and that comes back down to what is the strategy? And I have been very critical of the Federal Reserve for not having a strategy. They're too reactionary, and they do a lot of things that are not so helpful. They should pursue sound monetary policy that will get them to their target rather than their tactical shifts that they do. And I think that would be far more effective.
Yeah, still on the topic of inflation, the recent surge in inflation has caused concern among many investors, and particularly those who are heavily invested in the traditional fixed income investment. What strategies do you recommend for these investors to protect their portfolios against inflation risk? And what types of assets do you see as the most resilient to inflation? I know previously you've been tweeting about the Treasury inflation protected securities. So how would you approach that?
Well, I mean, every investor is different. I can't give specific advice for everybody, but you mentioned Treasury inflation protected securities. A lot of people don't understand what they are. They are Treasury securities. They also give you inflation protection. And of course, that's priced in when you buy them. And so when you buy tips, they're called. When you buy tips, you're locking in the real yield for a specific period. And so you can look up what is the real yield over 2 years, 3 years, 5 years. And so you'll get that. And so the price, because it's based on the CPI, and so the Consumer Price Index, and so you will lock that in. And so it's like anything else, right? Is that attractive? And to many investors, it is. But at the same time, of course, yeah, if you buy treasury bills right now, you also get a good yield. And last year, treasury and protected securities did not perform so well. And the reason is that as the Federal Reserve became more hawkish, the real yield was moving higher. And so as that was moving higher, the value of the existing tips went down. And so tips are a good investment if you believe if we've reached quote unquote peak hawkishness. It doesn't mean that rates can't go up anymore, but if you think that the Federal Reserve is not going to be tougher on a relative basis than they're right now, then tips can be a very good investment. Other than that, right, there will be a point when the Federal Reserve is quote unquote pivoting that longer term bonds are going to be a good investment again, right? But already, right, the Michael pointed this out, the 2-year yields have gone up dramatically. And we have this inverted yield curve because the market is saying, hey, we're going to have a recession here. The further you out go the yield curve, the more you're entering speculative areas, right? And if you are a concerned investor, you might want to stick to something that is not so far out. But again, it depends on the type of investor you are, because you know that, hey, if I buy something 2 years out, this is what I'll get over the next 2 years. And if you're comfortable with that, well, that's worth considering.
Okay, so it's so hard for us to have a conversation about inflation, given what you do, without talking about gold and the precious metals. I know that your company is so heavily involved in precious metals investments. So the price of gold has historically been driven by a variety of factors. And just as you have mentioned, the inflation expectations, geopolitical tensions. Right now, we have the crisis in Ukraine between Moscow and Kyiv and Ukraine. And the other factor that affects the price of gold is the currency exchange rates. Which of these factors do you think will be most important in determining the price of gold in the coming years? Would it be hyperbole to make the assumption that there is a possibility of gold hitting maybe 3,000 in the next 2 years?
So first, for context, we manage about $1 billion in gold and gold mining. So yes, we are quite involved in that space. I don't think that any one crisis, and say the Ukrainian crisis, is a key driver for the price of gold. What happens when there's a new crisis, then often the price of gold flares up. But the markets have an ability to get used to crises. It's very unfortunate, right? There's a terrorist attack somewhere, market panics. Well, within a short period, things calm down, and then you have more attacks down the road, and the market is barely moving because they know what's going to happen. So similarly, as tragic as an event like this is, there is a war or a terrorist attack or some other crisis tends to be shorter term. The question is, will a crisis get the Federal Reserve to move? And obviously the Federal Reserve is not necessarily moving because of Ukraine. Of course, you can say, well, maybe oil prices go higher and that slows the economy. When I look at the price of gold, one of the key drivers, and gold it's a brick, right? It doesn't pay interest. So what gold competes with is cash. If gold preserves the value better than cash, then it's worth holding gold. But it's not the short-term cash because markets are forward-looking. And so if you look at the correlation between the price of gold, you want to look at real yields further out, something like 5 years or 10 years. Now, a lot of people, presumably many that you talk to, saying, well, how on earth can you decide what inflation was going to be 5 years, 10 years down the road? Because nobody knows, the folks at the Federal Reserve not either. But there are still market-based measures to say what is a 10-year real yield. And we talked about tips, right? Based on that, you can see that, for example. And what these measures are, they are a measure of confidence in central banks, the Federal Reserve in particular, how they will manage the inflationary environment. And so if you look at the price of gold, we see a fairly high correlation to real yields further out. And as the perception changes of how the Federal Reserve will manage that, the price of gold is heavily influenced. But it's a very academic way of saying that I believe that the Federal Reserve is near a peak of how tough they're going to be. It's quote unquote priced in how tough they're going to be. And even though short-term rates may move higher, the price of gold can actually do quite okay. And so that's I think the real yields is one of the key drivers. That, by the way, to just round that out, the two other key drivers are investors who are quote unquote just looking for diversification. In an environment where the S&P always goes up, you don't need diversification. In the environment we are in right now, you do need diversification, and gold is getting an allocation for that. And the third one that might be addressing your question, historically, there had been a lot of speculators jumping on the price of gold, and that can cause volatility on the upside and on the downside. In recent years, a lot of these investors went to the crypto space or the meme space, and there has been actually less volatility in the price of gold. Should we get a pronounced period where the price of gold is moving higher, I would not be surprised if those speculators come back and that you can get a pop in a direction that's far more volatile than we have seen. And so I actually like it that these speculators aren't in there as much, because that helps a tad more of a normal process, except if you are gold investors, you have to realize that volatility can be quite significant in that space.
Okay, so we know that interest rates have remained low, and this has been the subject of our conversation for a very long time. Many investors have sought out alternative sources of yield, and my question really is focusing on emerging markets. So some of these alternative sources of yield are emerging market debt or real estate investments. What do you see as the risks and benefits of these investment alternatives? And how should investors incorporate these into their portfolios? And just direct to you, are you involved in emerging markets investments other than what you do in the gold space?
Well, in the gold mining space in particular, I'm very much involved in emerging markets. In my personal portfolio as a business, we don't do much. They are just from a mandate that we have. Personally, I had trimmed down before a year ago or so, trimmed down some of those. But hang on a second. Yes, I do have emerging market. It's in the bucket I don't look at. Right there, I have emerging markets as there I have an allocation. But it's a long-term investment, as we talked with Michael earlier. The timing is very difficult when those markets will perform well, right? And so I do have an allocation there. There are many risks in these things, right? And I can only touch on them, right? Volatility is high in emerging markets, and it is again something, right? Can you as an investor accept the risk that comes with these investments? You mentioned real estate, right? Lots of opportunities and risks there, but it depends a lot on so many different factors. I do invest in some international real estate, right? But it works for me. Ultimately, you want to know what you invest in and whether you can accept the risks that you pursue.
Yes, and previously, just a few moments ago, you talked about the crypto space. I just wanted to, to try to ask about that. As we move more towards a digital and decentralized economy, what role do you see blockchain technology playing in the future of financial markets? Do you see any specific applications of blockchain technology that could significantly disrupt traditional financial institutions and markets? You have talked about the cryptos, and do you think that could be disruptive to the business models that you and Michael have been practicing and have been promoting over the years?
Yeah, so let me give you a very quick answer because I have to run here. I do think the decentralized ledger, the blockchain technology, has very important implications, and there is lots of opportunities there. Buying a quote-unquote cryptocurrency is mostly just speculation. And the environment we're in is where regulators are piling in on things, so there will be some setbacks. But I'll just leave it at that for now.
Okay, so as we wind up our conversation, so I'll just ask the last, what parting advice can you give for investors who are starting out and or those who are already established? I know that
have a process. Yeah, have a process, and don't take more risk than you're comfortable with. If you can't sleep at night because of your investments, you have too much risk in your portfolio.
Okay, thank you so much for your time. It's really appreciated. Our conversation will have to end at this moment.